So the Fed can control or target M1 or M2 if it wants to. It can do it by controlling the monetary base, and it has some influence on the ratio between the broader monetary aggregates and the monetary base. It can change the monetary base by buying securities, as I just showed you. And as I said, they used to buy almost entirely treasuries. In 2008, they bought $1.4 trillion in mortgage-backed securities, so that was a change. They can also increase the base by lending to banks, and they did a lot of that during the financial crisis. That's pretty much been unwound. But the purchases of mortgage-backed securities have not been unwound, and the purchase of massive amounts of treasuries have not been unwound. So the Fed now has a very expanded balance sheet. Right? It used to be a little over $1 trillion, and now it's $4 trillion. The other thing the Fed can do is to try to change the ratio, the so-called money multiplier, between the broader monetary aggregate and the base. And what they've done by paying interest on reserves is to reduce that ratio. So it's offset, deliberately, offset the effect of the quantitative easing. So people who saw quantitative easing and predicted massive inflation weren't paying attention to the fact that the Fed was now paying interest on reserves. And it seems like a low interest rate. It's only 0.25%. But that's more than treasuries pay. So banks were quite happy to hold, are quite happy right now to hold massive amounts of reserves. Now, how long they'll stay happy if the economy recovers and demand for loans recovers is a problem going forward. So here's what happened. On the left, you've got the adjusted monetary base, that is adjusted for reserve requirements, but they haven't really changed over this period. So you see the shooting up of the monetary base. It more than doubles from a little over 800 billion to 1.6 billion. During the recession, the shaded area is between 2008 and 2009 is the official dates of the recession. That's QE1. Then it rises a little more gradually and flattens out. Then it jumps up again. That's QE2. And then it starts taking off again in 2013. That's QE3 plus. That's the Fed's program of, what was it, $80 billion a month. But here's M2 on the right. The path of M2 hasn't budged much at all. So the Fed has offset the effect of increasing the base by paying interest on reserves and other regulatory policies that have discouraged banks from lending and creating deposits. So you might ask, well, what was the point of QE 1, 2, and 3 if they didn't change the path of the money supply held by the public? Because if you increase the money held by the public, you should see more spending by the public. Evidently, that wasn't the plan. So what was the plan? Well, I think it's not a coincidence that this coincided with the purchase of $1.4 trillion in mortgage-backed securities. The idea was to boost the price of mortgage-backed securities, but not cause massive increases in the money supply. So the Fed bought the mortgage-backed securities and then offset those purchases by paying banks to hold the reserves that were being created. So the Fed has sort of gone from just controlling the money supply to now dickering, was that the right word? Fiddling with the allocation of credit. Right? So they say, we think the price of this asset should go up, mortgage-backed securities. Why? Because they think it would help restart the housing industry. But we don't want to cause inflation by just an unsterilized purchase, so we pay banks. So in effect, the Fed is borrowing from the banks in order to hold a massive portfolio of mortgage-backed securities and more treasuries, which is helpful if you're running a huge deficit, as we did a few years ago. Helpful to the Treasury. Keep the interest rate low. So this is how the diagram looks when we modify it in these two ways. So the original diagram ended where the dotted line is. Expand the quantity of bank reserves, but at the same time shrink the ratio of deposits to bank reserves, and you don't have a change in the sum of currency plus deposits held by the public. But you do have a massive expansion of bank reserves. So that's why I say this wasn't a monetary policy. That is, it wasn't directed at changing the path of M1 or M2. It was a credit allocation policy. Now, if you don't think the Fed has a mandate for credit allocation and that they were just making this up, giving themselves an authority that nobody had given to them, you might be a little disturbed by this, as I am. So the Fed has this enormously expanded balance sheet, and this creates what's known as the exit strategy problem. What are they going to do? Are they going to go back to normal? Or are they just going to sit with this enormously expanded balance sheet, which basically has made the Fed's traditional way of running monetary policy, which was adjusting the federal funds rate, and I'll show you that in a second, but using interest rates as a sort of intermediate target, it's kind of wiped that out, and that's why quantitative easing has taken place. But Alan Meltzer made this point 4 years ago, 4.5 years ago. How are you going to get the reserves back out of the system? Well, what Bernanke said was, if banks start becoming more eager to lend, and so the money supply starts to balloon, we'll pay them more not to lend. We'll raise the interest rate on reserves. And Meltzer says, well, you're leaving something out. How far are you going to raise the interest rate on reserves? If you raise it far enough, the Fed starts to lose money. How's that going to work? If you want to reduce the reserves held by banks, that means the Fed has to go out and sell off the securities that it's acquired. But it never seems like there's a good time for the Fed to shrink its portfolio, because that would make interest rates go up. If you sell Treasury bonds, you drive down their price, you drive up their yields. If you sell mortgage-backed securities, you drive down their price, you drive up their yields. Right? The whole purpose of the buying operation was to drive the prices up and the yields down. So this is unresolved. So the Fed's traditional policy, as I said, was to operate through interest rates. So they estimated sort of what interest rate would be consistent with the economy being on the path they desired. And they could stimulate the economy by lowering interest rates. And we saw this diagram in the first lecture as part of the circular flow, the part that went through the financial system. I said I would come back to it. All right, so we've got the supply and demand for loanable funds determining the equilibrium interest rate. The Fed operates on the supply side. The Fed can create more loanable funds by injecting reserves into the banking system, because now the banks can lend more. So that shifts the supply curve to the right, equal to the amount of additional money that's created, because that's equal to the amount of additional deposits created. And that drives the interest rate down. So you see the equilibrium interest rate where the two curves cross, moving downward and to the right as the supply curve shifts out. And so that's traditional Federal Reserve Fed funds policy. But it only works temporarily. The Fed injects more money into the economy and the banks do lend it out. That starts to generate more dollars of income, more activity and higher prices. Businesses that want to finance the same activity when sales are increasing and prices are increasing are going to have to borrow more dollars, because wages are going up and input prices are going up. So that's going to increase the demand for loanable funds. So that one is the dotted demand curve. The demand curve shifts out, and that drives interest rates back up. Right? And evidence that the Fed cannot permanently keep interest rates low can be seen in this history of the effective federal funds rate. If you think the Fed controls interest rates as precisely as it likes, then you would have to think they controlled them all the way up to 18%. Now, clearly they didn't want them to go to 18%, but the Fed was injecting so much credit that inflation was in double digits. That made interest rates go up into double digits. And how did they reverse that? They had to tighten monetary policy, bring down inflation, bring down expectations of inflation, thereby make people willing again to lend at single-digit interest rates. And since that was Paul Volcker's doing, since then, interest rates, this is just the Fed funds rate, that's an overnight interest rate. Interest rates have been trending downward. And of course now, you see beyond 2010, we've got a zero interest rate policy. The effective Fed funds rate is pretty close to zero, like 17 basis points. But there's very little going on in the federal funds market. The Fed funds market is where banks lend each other reserves. But there are no banks who need reserves these days. They're all awash in reserves. So there's almost no activity in the federal funds market now. So there really isn't much meaning to this zero interest rate. Any bank that wanted reserves could get them very cheaply, but nobody wants them. Well, when interest rates are zero, then clearly the Fed isn't going to be able to stimulate the economy by lowering interest rates further. Can't get them below zero. So that's why they've switched to quantitative easing. And they've also switched to trying to influence not just overnight interest rates, but longer-term interest rates. That was the so-called Operation Twist, where they tried to stop buying and selling short-term securities, which affect short-term interest rates, and switch to buying and selling 20 and 30-year treasuries. And so the Fed's portfolio now no longer has short-term securities, short-term treasuries. It's got 20 and 30-year treasuries in order to try to keep their prices up and their yields down. This means that the Fed is now a very highly leveraged hedge fund taking on a lot of risk. Right? We learned in the savings and loan crisis that if you have a portfolio of 30-year mortgages and interest rates go up, you're in trouble. Right? Because to finance your portfolio, you're going to have to start borrowing at higher interest rates. Your old assets are not going to change. They're already on your books. They don't expire for 20 or 30 years. You're stuck earning low interest rates while you're paying high interest rates. So people have run this simulation in recent months. And if interest rates go up by 2 percentage points, the Federal Reserve becomes insolvent. That will be interesting if that happens.